Hello friends, welcome to my channel. In this video, we are going to talk about Stallion India Fluorochemicals. It's a recently listed company working in the fluorochemical space, which is growing quite fast in India and has sector tailwinds. This was chosen in a Telegram poll with more than 660 votes. Now you can watch our videos in Hindi also. In the settings button, you have an option to choose the language and switch to Hindi. If you're new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos that we upload. Here is a small disclaimer as per SEBI regulations. You can pause the video and read it. This will be a flow of our discussion. We'll discuss the business model of Stallion in brief. Then we'll look at the chart. We'll discuss the financial performance of the company in the last 5 years. We'll understand why the stock has given such a sharp rally post the listing, the outlook of the management going forward, the valuations, the risks, and then we'll form an overall view on the company. So Stallion Indian Fluorochemicals is a company which mainly sells refrigerant industrial gases, and now they are expanding their non-refrigerant gases portfolio also. So up till now, mainly the company was into import of gases. Then they will blend it as per the client's requirements, repackage it and sell it. But now it is moving towards in-house manufacturing as well. They have more than 200 customers in 15 plus industries, and out of the total Indian refrigerant market, 10% market share is with Stallion. So this is how the business works. They import or source the raw material from abroad. So for them, the material is different gases like HFCs, HFOs, hydrocarbons and helium. Then they debulk or unload the container, put it in their own storage. Then as per the client's requirements, they blend it into different combinations, then test the final deliverable product, repackage it as per the client's requirements, and then deliver to the customers. So this was the business model they followed for the last 2-3 decades. They have been catering to several industries, mainly the air conditioner and the refrigerator industry. Along with that, this is also used these days in the semiconductor manufacturing, some part of automobile and defense, textiles, electricity generation, and several other industries as well. Now let us specifically talk about the refrigerant gases. HFCs and HFOs and hydrocarbons are mainly included in this. The customers prefer specific blend and combinations which this company combines and delivers to them. One of the main raw materials is R32, which now the company is setting up a new manufacturing unit to manufacture in-house. This will be a backward integration for the company and will drastically improve the margin profile of the company going forward. To reduce their risk, de-risk from the refrigerant gases, they are diversifying into non-refrigerant gases as well. These again are high purity gases and blends. These are used as pharma propellants, fire suppression systems, semiconductor fabrication, solar cell manufacturing, and other fiber active industries. The final business segment for them is the aftermarket products and consumables. So in the refrigerant and air conditioning, more than the first sale, the service sector or the aftermarket sales capture 80% of the sales. So along with the refrigerant gases, they are also supplying some accessories and consumables in the aftermarkets, which are a portion of the sales, but margin wise, these are much better than their first sale. When we speak about their manufacturing facilities, they have 4 manufacturing facilities at present, and they are adding 2 more, one in Andhra Pradesh with 7,200 MTPA. This is a debulking and blending plant. So this is again the same business model which they are doing until now, but there's a new manufacturing unit coming up in Rajasthan with a capacity of 10,000 MTPA, where they'll be manufacturing the R32 gas. This is a brief description of their business model. Now let's look at the stock performance post-listing. It was consolidating for a while post-listing and it was not really a discovered stock. Then post the merger completion and the good results in FY25, the stock came into the limelight. The IPO price was 90 and the stock gave a rally up to 425. So it gave a massive return for people who were holding for the last 1 year. And now there is a sharp correction and it's trading at around 320 rupees. If you look at the financials for the last 5 years, the revenue was 118 crores in FY21, which increased to 377 crores in FY25, which more than tripled in the last 5 years. You see a serious jump in revenue from 233 crores in FY24 to 377 crores in FY25. This was purely not organic. There was a company called Stallion Enterprises, which was a proprietorship firm of the director of this company, which got merged into Stallion India Fluorochemicals. So due to that merger, we see a sharp jump in revenue in FY25. EBITDA has been slightly volatile. FY22 was a great year with 33 crores of EBITDA, and then we saw a decline to 18 crores in FY23. And in FY25, because of the merger effect, we saw a sharp rise to 48 crores. Margins also have been volatile. In FY22, that being the best year, the margins were 18%. The reasons for high margins in that year, because post-COVID, there was a sudden high demand in all these chemicals. Then there were some import constraints which led to the increase in the domestic sales, and the pricing was also much higher in that year. So that was kind of an abnormal margin of 18% considering the existing business of this company. Thereafter, it fell to 8% and now it is somewhere around 13% in FY25. Going forward with the backward integration, the management feels that there will be further expansion in the margin to extent of about 3 to 5% as they are manufacturing R32 in-house. The ROE is about 15% because the company is undergoing capex. Working capital wise, it is a high inventory, high debtors business, so which we have to closely watch going forward that this should not go beyond the range. The cash flows are not at all impressive. In the last 5 years, the company has not generated positive operating cash flows. So if they want to grow forward after the IPO funds are over and if the cash flows continue to be weak, then they may need further fresh funding in the form of equity or debt. So as an immediate monitoring variable, this is okay, but couple of years down the line, this will become very critical to watch from an investor's perspective. Now, what led to the rally from that 90 to 400 in the recent 1 year? The financials improved. The company is moving from a blender to a manufacturer. So that will increase the margin profile of the company, and that led to the re-rating of the PE multiple. The company has also announced aggressive capex plans both for a blending unit as well as a manufacturing unit. So all these factors led to a sharp rise in the stock price. Before we move forward, if you're not a part of our Telegram channel, do join today by clicking the link in the description so that you join the correct Telegram channel. Every day before the market opens, I share my views on the markets, and I also share a lot of portfolio allocation strategies which will help you manage your portfolio better. More than 9,000 people are daily in touch with us on our Telegram channel. Now let's talk about the growth outlook of the management going forward. First, let's talk about the capex plans. In Andhra Pradesh, they are coming up with a 7,200 MTPA blending capacity. Their existing Khalapur unit is also being expanded to add another 1,200 MTPA capacity. They specifically want to focus on the semiconductor, helium and solar cell gases because these sectors are growing by double digits. So there will be strong tailwinds in these products. When we specifically talk about their manufacturing unit, which is coming up in Bhilwara, Rajasthan for R32, the capacity of which is about 10,000 MTPA, the capex spend would be around 200 crores. They would start the construction of this unit in November 2025 and the completion is scheduled to be in July 2026. So the second half of the year, FY27, will see the impact from this unit. Revenue potential from this unit would be around 500 crores, which is much higher than the present manufacturing capacity. And margins are something to look at. They are targeting a PAT of about 22 to 24%. Which is very high compared to the existing margins of the company. This will lead to the re-rating of the overall margins of the company. Other than the R32, they will also focus on adding further manufacturing of gases like AHF, MDC internally. For FY26, they are targeting a revenue of about 430 crores. And for the next 2-3 years, they are targeting a growth of about 30 to 35% revenue CAGR. Now let's talk about the valuations, which is the most interesting part. At one point of time, the stock was trading at just 15 times EV EBITDA, which rose to almost 50 times. So that is the kind of re-rating we saw in the stock. So when good results get combined with a PE re-rating or EV EBITDA re-rating, then such massive returns are created, which exactly happened in this company. Right now it trades at an EV EBITDA of around 38x. Its peers like Navin Fluorine have a median EV EBITDA of the last 5 years at 42x and Gujarat Fluoro has about 25x. So although this company still is a blender, they have not started manufacturing yet. That will get completed next year. Still, the market has already re-rated the company and it is giving a multiple similar to the other manufacturers in the industry, which have a much stronger and much older stable business. So the margin profiles of Gujarat Fluoro and Navin Fluorine are as high as EBITDA around 20 to 25%, but this company still has much lower margins. So what we understand that the re-rating of the multiple in this company for the next couple of years or so is already done. So the valuations are not very cheap from a value investor's perspective. So there is a possibility that there may be some correction in the stock. What are the risks of investing in this business? They are largely dependent on importing a lot of materials from abroad. The supply of those materials, availability of those materials, forex gain or losses could be a risk. The fluctuation in prices of those materials could be a risk. There is competition from existing players in India. The existing players are also expanding their capacities. They have planned a good capex, but everything should happen in time. Things should fall in place and they should really do those margins. So execution risk is always there. Working capital has to be managed very well going forward. If they continue to have negative cash flows, then they will need fundraising every 2-3 years, which the investor community doesn't like because the equity keeps getting diluted from an investor's perspective. So now that you've understood the business model of the company, the growth prospects, the valuations, the risks, the financials, what is our overall view on the stock? If you're already holding this company from the last 1 year and you've made this 4x, 5x kind of a gain, I suggest you to protect your profits by keeping a trailing stop loss in the short term, unless you have a 3-4 years perspective from the current levels as well. But from the next few months perspective, it is possible that the stock may get into consolidation for the next 6 months to 1 year. And if you're looking for a fresh entry in this stock from a valuations perspective, the valuations at these levels are pricey and you should wait for some correction and then gradually accumulate over a period of time. So that's about Stallion India Fluorochemicals. I hope you like the crisp analysis. I've tried to simplify the business and the other points in this 10-minute video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the names in the comment section. Do join our Telegram channel. Thank you for watching and have a wonderful day.